Why is the S&P 500 soaring while global currencies falter?
It's all about inflation metrics and the strength of the dollar. Joseph Wang highlights the implications of the latest reports, suggesting potential Federal Reserve rate cuts.
But that's just the beginning. Ken McElroy introduces the milkshake theory to explain how the US dollar is reshaping global economic landscapes.
Stay tuned as Wright sheds light on the alarming reality of the foreclosure crisis affecting millions of US homeowners.
Finally, Steve Hanke dives into the critical policy decisions needed to avert an economic downturn as we approach 2025. Don't miss it. Today is January 18th, and we're diving into the latest analysis from Joseph Wang on the recent surge in the S&P 500.
Joseph discusses how improved inflation data and strong bank earnings have contributed to this market boost.
Joseph Wang emphasizes the significance of the latest PPI and CPI reports, indicating improved inflation metrics that can steer market performance.
In particular, Joseph notes that the cooler-than-expected CPI could suggest that the Federal Reserve may consider rate cuts earlier than previously anticipated.
How does Joseph interpret the recent inflation data?
Joseph points out that lower inflation readings lead to increased confidence in market stability and potential Federal Reserve rate cuts.
What insights does Joseph draw from recent bank earnings?
Joseph highlights consistent loan growth reported by banks, suggesting positive consumer sentiment and economic health.
Joseph discusses the ongoing California wildfires. What are the expected financial implications?
Joseph mentions that home losses will predominantly impact insurers and could result in rising premiums that affect economic activity.
What does Joseph predict about interest rates for the coming months?
Joseph forecasts that should inflation remain stable, the Federal Reserve may initiate rate cuts in the first half of the year.
In conclusion, Joseph emphasizes the importance of keeping an eye on future inflation reports, as they will significantly affect market strategies.
Additionally, he suggests that understanding bank performance can provide valuable insights into overall economic sentiment.
Today, we're exploring the implications of the strengthening US dollar with insights from Ken McElroy, a leading expert in global economics.
Ken highlights how the dollar's role as a safe haven is reshaping investment patterns amid global turmoil.
Ken explains that strength in the dollar can create significant pressures on international economies that owe debt in dollars.
He notes that with the dollar's strength, many investors seek refuge in the U.S., driving higher demand for the dollar. Ken emphasizes that as the dollar strengthens, emerging economies, those reliant on dollar-denominated debt, are increasingly burdened with servicing costs.
This scenario significantly heightens the risk of financial crises in those regions. According to Ken, stronger dollar conditions encourage capital inflow into the U.S., thus boosting asset prices.
He explains that higher asset prices in the U.S. attract foreign investors looking for better returns. Ken introduces the milkshake theory, explaining how the dollar siphons off capital and liquidity from around the globe.
This results in a depletion of critical resources from emerging markets, further destabilizing their economies. What does Ken foresee for the dollar and its subsequent impact on global economies?
Ken predicts that if the dollar remains strong, it could instigate considerable instability in international markets.
Ken advises investors to stay vigilant regarding global economic indicators, as the dollar's performance significantly affects market stability.
He suggests that investing in U.S. assets continues to yield favorable returns, despite the global economic challenges.
Today, we're delving into the foreclosure crisis alongside Wright, who brings extensive mortgage and housing market expertise.
Let's unpack the troubling numbers behind delinquencies.
Melody asserts that the increase in mortgage delinquencies indicates a deeper issue of unaffordability in the housing market.
Indeed, the trajectory of delinquencies appears to correlate with rising interest rates and stagnant wage growth. As Melody explains, rising interest rates have exacerbated borrower stress, particularly among low and middle-income households.
This increased financial burden is critical, as many can no longer manage their mortgage payments. Melody discusses how government interventions, while well-intentioned, often lead to market distortions.
Exactly. Lessons from past crises remind us that a more hands-off approach could yield sustainable outcomes. Looking ahead, Melody predicts that the housing market will face tumultuous conditions as economic pressures mount.
This situation will affect not just current homeowners, but also potential buyers entering the market. Melody speculates that while home prices may decline, buyers must exercise caution due to economic instability.
Smart home purchasing decisions will require careful consideration of personal financial health and prevailing market conditions.
In conclusion, staying informed about current market dynamics is crucial for navigating future challenges.
By keeping a close eye on personal finances and market trends, viewers can better prepare for potential shifts in the housing landscape.
Today, we're exploring the nuances of the stock market with Matt from Trade Brigade, emphasizing market trends and effective trading strategies.
Matt illustrates how external economic factors shape market behaviors and trading outcomes.
Matt underscores that grasping external economic influences is vital for trader success.
He elaborates on how these factors create opportunities and volatility within the market.
What insights did Matt offer regarding AMD's stock performance?
He indicated that AMD is stabilizing near essential support levels, advising cautious trading.
As we approach earnings reports, how should traders position themselves?
Matt advises monitoring sectors closely, as earnings announcements could lead to significant market volatility.
What predictions did Matt make regarding potential market shifts?
He anticipates heightened volatility as the market reacts to upcoming earnings announcements.
In summary, what essential points should traders remember?
Matt concludes that a disciplined mindset and vigilant market observation are vital for navigating today's market landscape.
Welcome, everyone. Today, we will analyze the 2024 holiday shopping season as discussed by Steve Van Meter.
Steve highlights significant concerns regarding consumer purchasing behavior and recent retail performance.
Steve points out that the retail sales data reflects a more substantial decline than expected.
He emphasizes that while job numbers appear strong, consumer confidence is undermined by economic anxiety. Steve explains the ongoing shift towards lower-priced products, which negatively affects retailer profits.
This change illustrates a broader concern regarding financial stability among consumers. According to Steve, stagnant wage growth leaves consumers lacking necessary spending power.
Retail sales data shows troubling trends when viewed through inflation-adjusted metrics, indicating economic distress. Steve warns that ongoing layoffs may precipitate further declines in retail demand.
This situation poses risks for consumer spending and may lead to additional retail closures. Steve predicts that without a boost in consumer confidence, retail performance will remain subpar.
He believes that reduced optimism will result in restrained consumer spending going forward. In conclusion, Steve underscores the necessity for retailers to adapt to evolving consumer expectations.
He warns that without improved consumer sentiment, retailers may encounter significant future challenges. Today, we are joined by Steve Hanke, an applied economics professor at Johns Hopkins University, to discuss the economic outlook for 2025.
Hanke argues that extending current tax cuts is essential for preventing an economic crisis in 2025.
Steve Hanke insists that extending the 2017 tax cuts is critical for sustaining economic growth in 2025.
In contrast, Janet Yellen warns that keeping these cuts could worsen the nation's budget deficit.
Hanke emphasizes that government spending has led to record-high deficits.
He calls for shifting from wasteful expenditures to productive investments to improve the economy. Hanke points out significant differences between U.S. economic performance and stagnant growth in Europe, attributing it to high tax burdens.
He maintains that lower taxes are central to fostering incentives for saving and investing. Hanke strongly opposes proposed tax hikes, stating they would drastically slow economic activity.
He argues that keeping current tax structures is essential to prevent recession.
Hanke predicts a challenging economic climate in 2025 unless existing tax cuts are maintained.
He notes that inflationary concerns could compound if fiscal discipline is disregarded.
In summary, Hanke suggests that ensuring the renewal of tax cuts is crucial for economic well-being.
He highlights the necessity for citizens to understand economic policy effects on personal finance.
What a whirlwind of insights we've wrapped up today.
Absolutely, we've heard from some heavyweights on economic policy and market trends.
Right? Steve Hanke's call for permanent tax cuts versus Janet Yellen's emphasis on the need for revision really sets the stage for a vital debate.
And it's fascinating how Steve Van Meter zeroes in on consumer behavior, showing us that not all is rosy in retail despite rising stock prices.
Yeah, Matt's disciplined trading approach seems crucial, especially amid all this uncertainty.
Definitely. Then you have Melody Wright pinpointing the housing crisis, making us think twice about the implications of rising foreclosures.
And Ken McElroy's insights on the strong dollar could broaden our understanding of global currency pressures, right?
Spot on. That global perspective really highlights how interconnected our economies are.
Speaking of connections, if you found all these insights valuable, give us a thumbs up and subscribe.
Your support means we can continue to share expert opinions and unwrap these complex topics.
Don't miss our next video where we dive deeper into emerging market trends. You won't want to miss it.